Hi, welcome to the second episode of a four-episode series on the Unoriginals by Bhavin Gandhi. Welcome, Bhavin.
Thank you.
So before we dive directly into the technicalities, I have a personal, very curious question
Sure.
from you. Why the name The Unoriginals?
Okay, so the book that the book is actually a compilation of multiple notes that I've written over time, and obviously none of those notes were my own, right? So basically, when we compiled the book and we were putting it out, we thought what should be an apt title, and we thought since none of the notes are original, maybe Unoriginal is an apt title for the book. So
That-
that's how we kind of came up with.
That's very interesting, actually. So, in the first episode, that was the previous episode, we discussed the topic growth versus capital inefficiency. The topic for today's session is expectations investing. So, I will start with a very basic question, Bhavin. How can you explain expectations framework in a very structured way? And what do you think are the key building blocks that investors should look at?
Sure. So before I just dive into the concept itself, if we can have the slides up. So these are some of the concepts that we discussed in the previous episode as well, but it's best that we touch on some of these concepts because these are the building blocks for the expectations framework that we'll discuss today. So if you can see on the slide, this is something that we discussed, that the four pillars of valuations really are the cash flows that the business is generating, the return on capital employed, growth, and the cost of capital, right? And these four elements really drive the value of business, and what one needs to focus on is whether the growth is accretive or dilutive. The growth can only accrete value when the return on capital is more than cost of capital. This is something very, very fundamental to this concept of expectations framework. If we can move to the slide number 2, again we had discussed this slide in the previous episode, and if you were to refer to this slide, we had discussed the non-linearity of growth and ROIC in the episode, and I did mention that ROIC kind of has diminishing utility. After a certain threshold ROICs are met, the incremental improvement in ROIC does not accrete too much value, whereas growth has increasing margin utility. So that's again a very important frame to keep in mind. But now let's build on this same concept that we had discussed last time, right? So now if you focus on the second column where the business is generating, let's say 20% return on capital and is growing at 20% per annum, right? The fair multiple to pay for such a business is, let's say, 38 or 40, as you can see. And if you are paying up 50 times for that business, you are essentially saying that this business will deliver 25% growth for the next 10 years. And only then you will make cost of capital on that business, right? So this is in very, very simple terms, expectations investing. Basically, instead of judging the value based on price to earnings, price to book, EV, EBITDA, etc., what we are trying to do is unravel what the market price is telling us. So when we look at the PE that we are paying up today, we are just trying to back solve as to what kind of growth we are paying up for, and then judge whether that kind of growth which we are paying up for is likely to happen or is unlikely to happen. And that's in a very, very simple framework, what expectations framework is all about.
Okay. You had in the book also you had mentioned that this expectations framework is outlined from the book Expectations
Sure.
Investing by Michael Mauboussin.
Yeah.
How do you think it differs? And by differ, I don't essentially mean diverge, but also in that capacity probably refines or probably extends also
Sure.
from the book that I
Sure.
just mentioned.
So, like I mentioned, the original idea of this concept of expectations framework came obviously from the book, and it's a beautiful book. Somebody who's not read it, I think it's a must read. But what we have tried to do is just go beyond where the book kind of ends. So the message, in a nutshell, the message of the book is that instead of thinking about valuations in terms of these multiples, think about what you are paying up in terms of what the market price you are paying today. What are the expectations built into the stock? So like I mentioned last time also, the market cap today is nothing but market's expectation of long-term cash flow generating potential of the business, right? So the book tells us or advises that you try and unravel whether these expectations are realistic or unrealistic, right? And the book that kind of ends there. So what we try and do is build on this concept, and instead of ending there, we kind of go back doing the same exercise for, let's say, last 10 years. Okay. So every year for last 10 years, what were the multiples the stock was trading at? And at those multiples, what was the market discounting in terms of long-term expectations, right? Now that's a very good setup to kind of look at and see really the mind of the market. How has the market thought about this company that you're looking at over time? And it also kind of tells you what will it take for the market to change its view. And market generally does not change the view on a stock very easily. A lot of things have to change for the market to change its view. But this whole roadmap, and we have a small example for this at the end of the conversation. I'll probably explain that. But that kind of tells you how the market has been thinking about this name and what will it take for the market to change its view. Right?
Okay. So one more thing that really interests me in your book is that you argue that the traditional valuation multiples,
Sure.
like the PE and PB, they are insufficient.
Yeah.
Why do you think that, and what do you think are the key shortcomings of these kind of multiples?
Sure. So again, going back to what I said some time ago, the four elements which are kind of driving the value are cash flows, ROIC or return on capital, cost of capital, and growth, right? And all of those four elements are in a constant state of flux. They don't stay static over time, which means that a static number like a P or an EV EBITDA or price to book over time tells you nothing, unless you also look in conjunction as to how these four elements have changed, right? So that is where this is the key shortcoming of those parameters like price to book, price to earnings. They are just static numbers. They don't take into account changing cost of capital. They don't take into account changing ROIC profile, or they don't take into account inflection in growth of a business, etc. Right? So unless you are kind of back solving for all of these elements, which generally you can't by just looking at these measures, it will not throw up a complete picture. And that is where I think the real shortcoming of those measures lie.
Okay. So just correct me if I'm wrong. So what I understand is that it's wrong to look at them in isolation, but
Sure.
it's right probably if we look at them with other.
Correct. So basically, there is nothing wrong in you. These are shorthands for valuation, and you can always use them, but use them in correct context. So for example, if you're using a P ratio over time, you have to also take into account how the business characteristics have changed. Have the ROIC profile of the company materially improved?
Okay.
Has the growth inflected for the business? How the cost of capital has changed? If you look at those valuation ratios in conjunction with all of these elements, maybe you'll still have the right answer.
And this is how expectation framework also solves for.
Yes.
Okay.
Yes. So basically, if we can, there's another important concept that probably I wanted to cover is slide number 4. So again, people perceive that if you buy great businesses, you will have great outcomes. Again, there's clearly a problem with that statement. And this is core to expectations framework, which is basically saying that if all those great characteristics are already in the price, then the outcomes might not be great.
Okay.
And sometimes you are buying not so great businesses, but the expectations are far inferior to what the business is likely to deliver, in which case also you can have good outcomes, relatively good outcomes. So basically what the fund managers claim to alpha could be generally is that when you buy into a business, the business delivery is actually better than what the expectations are already baking in. And only in that node, a fund manager is able to deliver alpha. While the fund manager may claim that he is a value or a growth investor, but I think those are just labels. The only claim to alpha that a fund manager might have is when he's buying into a stock with low embedded expectations and those expectations are beaten. That is where your fund manager kind of delivers alpha
Makes sense.
to the investor.
Another question.
Sure.
How do you think that the expectation framework, do you think it works uniformly across all kind of businesses? We have cyclicals, we have financials, we have different types of technology companies, or is it focused on one particular sector or? type of business?
So I think generally the the principles generally work universally. I don't think there are too many exceptions to it. Yes, but there are some businesses which are not amenable to expectations framework. For example, commodities. So generally, in essence, you typically buy commodities at the worst point in their cycle, and at that point in the cycle, the business might not be generating any return on capital, right? Forget about covering cost of capital. In which case, the expectations investing doesn't work. But there are workarounds. There is a way you can work around these issues. Similarly, if the business is currently loss making, there is not going to be any return on capital, and in which case the expectations investing might not work if you are using the current earnings to decipher what is the stock baking in, right? So in some of these cases, you have to normalize for their earnings and then look at them, but there are workarounds. So I would say generally it works across different set of companies. There are a few exceptions here, and there will be a few workarounds that one has to do to kind of use this template across all kind of companies.
Okay. So I think in our conversation here and there, you have mentioned that how one can look at expectation investing or probably incorporate in their own investment framework.
Sure.
But can you specifically explain how expectation framework, is there a real life based or probably empirical evidence
Sure.
to understand this particular framework?
Sure. So let me actually show you an example of how this template can be used. So if we can move to the next slide, which is I think the 5th slide of the deck. What we've put out there is the price to earnings multiple of a stock over a 15-year time frame. And we've also put out the other elements, which is the ROE profile of the company, the growth which the business is delivering, and the cost of capital. And you can see that all of them are in a state of flux. Nothing is remaining constant, right? So now, if you look at the PE multiples of this business between, let's say, 2011 to 2015, when the stock was trading anywhere between 11 to 12 times, the implied growth that was built into the stock, as you can see in the last row, was about anywhere between about 5 to 7% in that kind of range, right? Now go fast forward to 2017-18 and you will see that the multiples were 70% higher. So the multiples were actually 16-17 times versus 10 times. But if you look at the cost of capital, if you look at the implied growth expectations, has not materially changed. And why has that happened? This is primarily because the cost of capital over this period has come down. So what the cost of capital used to be around 12-13%. And that came down to around 11 to 12%. That was the only variable that materially changed in that period. And you will see that the expectations that you were buying into stock at that point in time, after a 70% increase in the valuation, was not any different. So I think this kind of insight, a PE multiple will not be able to tell you. In fact, when you were buying the stock at a 70% higher PE, you were buying it at the same expectation that was there earlier. Now, this doesn't guarantee that you will have a good outcome. The stock has still got to out-deliver this 5-6% expectation was that there was built into the price. But again, this is a great frame to have, and at least you have a note to think about whether the business can out-deliver 5-6% growth or not, right? And then this is the edge that expectations investing kind of brings into the table in an expensive market like probably we are in today. The stock will still be able to tell you where the value lies, because it kind of distills through all of these three elements which are kind of in a state of flux, and tell you what is the expectation that is baked into the price and whether those expectations are realistic or unrealistic. So the least one can do is refer to that table that I've given out that we discussed last time around also, and see what you're paying up. Again, like I mentioned last time, what are you paying up when you're buying the stock at these valuations, and think about whether those expectations are realistic or unrealistic. That's a simple template to have. Even if you were to not get into these kind of nuances, that's a good enough insight to have when you are looking at buying into any company.
Okay. All right, Bhavin, that's it from the questions I had. Now we
Sure.
have a few questions from the audience, which
Sure.
I will be taking up.
Sure.
So the first question is, when evaluating a stock,
Mhm.
which of the four drivers, I'll mention the four drivers that you had mentioned, the cost of capital, ROIC,
Yeah.
there's growth, and then there is cost of capital.
Yeah.
Which do you think one should prioritize the most initially?
So there is no sequence in which you approach this framework. All of the four elements are working in conjunction. But I would pay a lot of attention to the ROIC profile of the business and the kind of growth that you are baking in. The ROIC profile purely from the perspective that if the ROIC is less than 11-12%, the business will rarely create value, right? So it's important that the business is generating return on capital which is a spread over a cost of capital. That's very important. And growth is also not very unrealistic. So, obviously growth creates a lot of disproportionate value, but it's very difficult to sustain high rates of growth for an extended period of time. So, even if the growth expectation is on the higher side, that also is a problem. So, I would focus on these two elements more, probably than the other two. But like I mentioned, all these four elements are working in conjunction when you are looking at an investment.
Okay. So just a follow-up question on this one
Sure.
particular question. How do you personally calculate implied expectations of a stock price?
So it's very simple. Like I mentioned, this is a very simple template to have. I think we have in our internal systems we have automated this process, where the P multiples can be back solved for, and it just tells you what the expectations are. Then the first cut that we apply here is look at the history of the company and go back and see whether the company has at least delivered this kind of growth in its own history. If it is not delivered that kind of growth in its own history, it's very unlikely that it will deliver it now, unless there is something which is fundamentally changed with the business, right? Unless nothing else is changed, then probably the company is more mature now than it was 5 years ago, which means that the law of averages will catch up and that kind of growth will not come through, right? So if the company in its history has not delivered the kind of growth that is baked into the price today, we are slightly more skeptical, unless we have a very different take about the business now, which has changed fundamentally from its own history.
Okay. A very similar question again.
Sure.
Given this framework, what does current Indian market's PE level imply about the earnings growth the market is already assuming? And do you think that's realistic right now?
So I would not apply this concept to index as a whole, because index is a culmination of different companies, different kind of companies with very different ROIC profiles, etc. So generally this concept does not work very well, and I would advise caution against using this at an index level. I would use it to evaluate individual companies bottom up rather than top down. I don't think it gives you a great outcome if you look at it from an index level. And
Okay.
I would rather not use it from that perspective.
Okay. Okay, so one question is a very realistic one actually, that most investors, they do not have access to the kind of models that we are talking
Sure,
about right now,
sure.
right? So what do you think is the basic minimum requirement that an involved investor needs to reverse engineer the market expectations on their own?
So one simple approach could be that you have a copy of the book. The
Okay.
first page of this book is actually a table which we've kind of given out. The other way, simple way, is to look at the table that we've shared at the beginning of this presentation also, which also gives you the same framework. And this table is a part of my core framework document as well. So if you go onto DSP's website and look at my investing framework, it also will give you the same table which is out there. So the least one can do is look at the table, look at the multiples that you are paying up, and compare it with the company's own history, and that will give you a good insight to begin with, and then you can start, developing your own understanding on the company, etc.
Okay. So you just mentioned that a great company is not actually a great investment. You mentioned it in one of our
Sure.
conversations.
Sure.
Can you give a real life example where from Indian markets where this has actually played out, that a business which was excellent but the stock still destroyed wealth?
So rather than naming companies, we can look at sectors also, right? So a couple of years ago, defense was a sector which was in flavor because you had the Russia-Ukraine war, etc., and the multiples, clearly went up significantly. And at some point, you had started discounting that some of these Indian companies become larger than their global counterparts sometime in the future, right? And although it's not unlikely that that might happen, but it was an unrealistic kind of expectation that was getting built into the stock prices of some of these defense companies, and we've seen what happened after that. So that's very typical of the market, that you tend to extrapolate the current present outcomes into the future, and then the multiples get extended, and then those expectations becomes unrealistic. So that's probably one example which I can think of in real market, which has happened a couple of years ago.
Okay. I think that was a great conversation, Bhavin. Thank you so much.
Thank you for having me.
And thank you so much, everybody, for joining us. We'll see you at the next episode. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.